broadcast is now starting. All attendees are in listen-only mode.
Well, good morning. This is Jamie from Stonehearth. Welcome. Today we're going to talk about estate planning. This is our 10th campaign, educational campaign that we're holding for clients. Just a reminder, if you want to review any of the prior campaigns that we've run, you can view those right on our website. We recorded the webinar just like we're doing today, and we also post white papers for a shorter tutorial on the main issues that were addressed during the webinar. So thank you again for joining me. I have a couple of housekeeping line items. The GoToWebinar control panel at the bottom, there should be a question area. So if you have any questions, just go ahead and submit those. They'll come directly to us. I will address those at the end of the presentation. Again, at the end, there's also going to be a disclosure. Just a reminder, I'm not making any recommendations for anybody today. My goal here is just to educate people on the issues, the areas that they need to explore or should give consideration to. Especially when things are pertaining to legal, which is going to be most of the discussion today for estate planning, and also accounting line items, you really need to see a qualified attorney or an accountant, because that's what they specialize in. So today what we're going to discuss are the composition of an estate plan. What that basically means is, what documents do I need in order to have a sound or comprehensive estate plan. The second area that I'm going to address are important life stages. Not everybody needs all of the documents that make up, quote unquote, a comprehensive estate plan. There are certain times in your life where you might need only a couple of those documents, and then in other stages of life you might need different documents. The third area that I'm going to discuss is probate. That seems to be always a hot topic for a lot of families, with the goal of avoiding probate. I'll talk about that. One of my favorite areas to at least discuss, it's because it wreaks so much havoc, especially here in Massachusetts, is state taxes, both the federal and the state side. I'll follow up with, how do you implement all of these things? How do you get all of these documents? Obviously, attorneys are available in this field, in this area. We're talking specifically about estate attorneys, not general attorneys. And I'll also talk about do-it-yourself options that are available. And I'll finish with an idea to give you a free review frequency as to how often you should dust off your estate planning binder and take a look at it. It's actually not quite as scary as a lot of people think it is. You can actually make sense of at least the most important line items, like who's going to control your estate, who are the beneficiaries. I mean, those are the most important pieces of the estate plan. All right, so let's kick things off. What is estate planning? It's taking the time to put together instruments or documents that are necessary to help manage and distribute a person's estate during life and after somebody passes away. And just to define what estate is just people's assets. Cash in all your chips, and what is it that you own? So if you have a house that's worth $500,000 and you have a $200,000 mortgage, well, if you cash in all your chips, you have $300,000 of equity that would be left over. Life insurance is a part of your estate plan. In most situations, there are actually ways that you can get it to be held outside of your estate as well, which will become important when you're thinking about ways and strategies to reduce your estate tax exposure. Who needs a plan? I would say, I used to say everybody, but there are scenarios where not everybody needs an estate plan. I have some clients that are up in Vermont, and they met with an attorney, and the attorney suggested that they just adopt the government's, the state of Vermont's plan. People under the age of 18 usually don't need a plan, especially since they're not legal adults and can't sign these documents. So just about everybody else needs to. If you want to have control over how your assets are managed or distributed while you're alive and after you pass away, then you really should look at an estate plan. Without that, as I mentioned, in Vermont and all states, the government has a default plan for you. They will dictate who inherits your assets, who will act as guardians for your minors if you have children, and they'll also appoint personal representatives who will handle your financial affairs and handle the estate in terms of how are these assets supposed to be distributed according to the government's default plan. You may like the government's default plan, you may not. I think that for most people, they want to have more control over it, so they would incorporate their own plan. And it's not that hard to do, as we'll address here. So let's focus on the composition of an estate plan. There's two primary areas that you focus on: planning for incapacitation and planning for death. Planning for incapacitation, we are all more likely to become disabled or incapacitated than we are to pass away. So these are pretty important documents. I'll review the four major ones. Durable power of attorney for health care, just to make this environment more confusing for people. They call these a health care proxy as well. There are a whole bunch of other words that they use for these. In essence, what you're doing is you're appointing an attorney or an agent, not a real attorney. They just call it an attorney in these documents. So if I want my wife to act as my healthcare agent or attorney, then I will list her in this durable power of attorney for healthcare document. And a lot of people have received these documents from their primary care physician, who obviously wants to have documentation to be able to take instructions from somebody, a loved one, or somebody that you trust. Hospitals, I've also heard, when you're admitted, especially if you're going in for a procedure, they will ask you to sign a document giving somebody else control to make health decisions on your behalf. The next one is a living will. This is sort of, do you want to donate your organs? Do you want to be cremated? Do you want to be buried? How long do you want a machine to help you breathe? I mean, these are all the things that you can document and put in place to sort of alleviate some pressure in the decision-making process of your loved ones as to how long they wait. What did they do? If you document these things, this is just going to be sort of a little bit easier for them, obviously, when they're going through a very difficult time. Durable power of attorney for finances. This is a document that we look for quite often whenever somebody's become incapacitated. So we are more in tune with looking at this document. Similar to the healthcare one, this one handles your finances. So if it's involving taking on a loan, depositing assets at a bank, withdrawing assets from a bank, making trades in your investment account, selling your house, these are all documents that roles that would fall under the document of durable power of attorney for finances. And then finally, trusts. Trusts tend to be a little bit more all-in-one type solutions, so that within the trust document, it will actually dictate, in the event that if I'm the current trustee, who's the person who's controlling the trust, if I became incapacitated, there is usually language in there that say, if I become incapacitated, then the new trustee will be my daughter or my spouse or a friend or family member. So trusts tend to have that language already baked into them for planning for incapacitation. The next component of the estate plan is to take care of things after somebody passes away. The most typical one that people will identify is a will. A lot of people have wills. I hope most people have wills. I hope everybody on this on this webinar has a will. In the will, you identify a personal representative. That's the person who's going to handle the process for you after you pass away of distributing your assets. If you have children, you want to identify a guardian as to who's going to take control of handling the day-to-day and the physical custody of the children. And then there's also, you can have a conservatorship where they will handle the finances. They don't, for the children, they don't have to be the same person, but they can be the same person. Finally, in a will, you can name beneficiaries. So if I were to pass away, I might leave everything to my wife. I'm sure she hopes I do. And then if my wife were to pass away, I would have everything go to my children. Since I have young children, what you typically do is you create trusts, which is the final piece that I've listed here under wills, so that a trust will control the assets, or a trustee will control the assets that have been deposited into the trust for the benefit of my children. And you can, the nice part about trusts is that you can specify when you want your children to inherit or have access to those funds. The trustee, obviously, throughout their entire, during your children's lives, will obviously take care of things like their well-being, health insurance, food to eat, but then, and also educational expenses. But then when does the trustee step back and give control to make decisions with regard to the inheritance? That's when we're talking about delaying some of that access. And trusts do a really good job of doing that. If you don't do that, then most children will end up getting control of the assets at age 18. Again, under planning for death, you see trusts here again. Trusts are a very common instrument that's used, especially for wealthy families. It doesn't have to be for just wealthy families, but it is more common. Trusts do a great job of helping to avoid probate, which is the #1 reason that people like to incorporate trusts. Another way that you plan for death is titling of assets. So if I own things in my own name, well, then if I don't have a will, then how do people know how I want these assets to be distributed? So if I really wanted my wife to get that, it would be much better and easier if I just held the account as a joint with rights of survivorship titling, so that my spouse would just take automatic ownership of the account when I pass. Beneficiary designations. Beneficiary designations are sort of a must. They require them for life insurance and for retirement accounts. Of course, you could always list your estate, but it sort of defeats the purpose for most scenarios. So beneficiary designations is a way that you can plan for your death so that when you pass, these assets will flow to another individual or even an organization or a charity. Life insurance, another great tool that will require beneficiary designations. And it will pass those assets on to your loved ones in the event that you pass away. Let's talk about the different life stages that you might want to consider incorporating certain documents, and maybe not all of the documents. So people under the age of 18, well, they're not even considered legal adults. They can't sign these estate planning documents. So, you know, it isn't usually a problem, because under age 18, the parents can take care of all the legal and financial and medical decisions automatically because the child is under the age of 18 and they have a parent or somebody that's in custody of the child. It gets a little bit more confusing when somebody turns age 18. In most states, they recognize age 18 as the pivotal point in time where a child becomes an adult, at least from a legal point of view. And the challenge with that is, if the child went to the hospital and became incapacitated, the parents have lost their automatic control to make medical decisions on behalf of their child. So what we suggest is that when you have an 18-year-old, download the forms. And what I'm really referring to are these right here: the durable power of attorney, living will, and a durable power of attorney for finances, both the healthcare and the finances. That will enable the parents, if the child, you do need the child to sign off on this, but if the child signs off and gives their parents the authority to make medical and financial decisions, then that power for the parents will continue going forward. There really isn't much need of having a will, although they are now of legal age that they can sign having a will. In doing research for this, I actually learned that in Georgia, somebody as young as age 14 can actually have a will. So that was kind of a little surprising. But by the vast majority, it's age 18. The challenge is most 18-year-olds don't have assets to speak of. If anything, they many times have debt or are accruing more debt through student loans. So the whole idea of having a will isn't quite as important. Obviously, there are exceptions to this rule, but for most 18-year-olds, the primary documents that you need are the power of attorneys for healthcare, finances, and a living will. Things change when you get married. You might not want your parents to make legal or medical decisions on your behalf any longer. So you most likely want to update your power of attorney documents, healthcare and finances, and the living will. The other thing that married individuals really need are wills, just to make sure that, hey, as they start accumulating assets, they want to make sure that their spouse inherits those assets. Then it's important to have a will. Many times when life is simple, they call these sweetheart wills. And sometimes people have sweetheart wills their entire life until they pass. Sweetheart wills just leave everything to each other. And then there's also a secondary, which would be the children, which is my next bullet point here. As soon as you have children, the most important part, not only do you need those other incapacitation documents, you also need a sweetheart will at a minimum. But within the will, you need to identify who's going to take, who's going to care for my children in the event that we pass away. That's a super important line item. That's usually incentive enough to know that the government's going to make that decision for you. And I know a lot of people that would not be comfortable with that, that they want to identify who would be there to take care of their children. When you hit retirement, again, hopefully you've got already all of these documents that I've referenced so far. It's also a good idea to take a look at trusts at that point in time to see if they're appropriate for you. Trusts, as I mentioned before, avoid probate, and trust work also can help reduce estate taxes. So as you hit retirement and later, that's hopefully the time when you're going to have the most amount of assets in your lifetime. And so trusts would be an important component of that to help control estate taxes or estate tax exposure. Other times that you want to dust off your estate plan is when you have a passing of a spouse. While it's not always required, because we normally within a comprehensive estate plan, we list a primary person to fulfill a role, whether it's the plan representative or the estate representative, or whether that's a beneficiary. So if I want my wife to control my estate and I want her to be the beneficiary, if she were no longer alive, if she passed away, then maybe I want my brother or maybe I want my sister-in-law to handle that. So you usually, when you create these documents, you usually already have secondary people in line. That being said, many attorneys, when they hear that somebody's spouse passed away, they will also suggest updating the documents and just moving secondary in line up to a primary role. It doesn't hurt to also just review. That's obviously a stressful point in your life when you lose a spouse, for sure. And it's also not a bad idea to take that opportunity to revisit your estate plan with the attorney to just make sure that everything that you want is still in place. The final one that I've referenced here is divorce. You need all of the, most times you need all of the rules to be updated. I still have seen clients or prospects come through and in the throes of dealing with a stressful divorce, it's just something, and a change in lifestyle. They just never got around to updating their estate plan. Hopefully they've changed beneficiary designations on most of their accounts, but inevitably the will is that catch-all, so it catches anything that was not already passed to somebody else by beneficiary designations or operations of law, like a joint account. Then if you never updated your will, then your ex-spouse is most likely going to get something. So it makes sense to take a look at that. I always like doing these, so I've actually created a couple of polls. Let's see if I can actually launch this one. Okay, hopefully you can see this. Which type of ownership is most likely to result in probate when the owner passes away? Go ahead and enter. Nice, I can see you guys are entering it. looks like we got a good audience today, so thank you again for attending. Well, here we go. We got 63% of you that have voted. So we got some people that maybe stepped away for a little bit. All right, we got 75%, good. So let me close the poll, and I gotta share the results here. So most people identified that a personal account is something that would result in probate when the owner passes, and you are correct. That is the asset or the account that we're always looking for to bring to people's attention that this is going to be something that's going to go through probate. An easy way, even if you want to keep an individual or a personal account in existence, an easy way to help avoid probate is just reach out to wherever the personal account is and ask them if you can name a beneficiary designation. That will solve that because beneficiary designations supersede the need to go through the will and the probate process. So that's good. Good job. Let's go back here. Let's get to the next step, to probate or not to probate. That is the question. So first of all, what is probate? Probate is really anything that's in your will that you need to distribute and handle, or at least your estate representative needs to handle on your behalf once you've passed away. This is involving the court systems. There's probate court, and they are the ones that are overseeing this process of making sure that everything that is in your will is followed by the estate representative. And it's also a process of notifying the public and notifying any creditors to give them time so that if you owe somebody any money, it gives them time to get paid after you pass away. So one of the most popular questions we always receive is, what are the ways to avoid probate? I just asked that through the poll. So a lot of you identify that personal accounts obviously are a problem if you're trying to avoid probate. So one of the solutions is add a beneficiary designation, and that was my third bullet point here. Second observation is joint ownership. You can own a house jointly if you're married. They call it fee simple. Actually, it's tenants by the entirety if you're married. If you're not married, you can call it fee simple. That is the equivalent to joint ownership with rights of survivorship. If you own it as tenants in common, just be aware that that is not going to avoid probate. So you got to be careful and just make sure that when you own things jointly, that it's joint with rights of survivorship. That is usually the default, but non-spouse joint owners will commonly own assets as tenants in common. And what that does is if I own something with my brother, if I pass away, I still want my share of the ownership to go to my family and not automatically be transferred over to my brother like it would have if we had done joint with rights of survivorship. The first bullet point that I have here is use a trust. Trust, that's one of the primary ways, or primary, I'm sorry, not ways, but that's one of the primary reasons why people establish and utilize trusts is to avoid probate. Just a quick tidbit, if you do incorporate trusts, just make sure that you fund them. I saw a study years ago. I don't know what the study is nowadays because I think attorneys and planners are doing, financial planners are doing a much better job of bringing this to people's attention. But if you have an estate plan that incorporates trusts, if they're supposed to be funded, that means you're supposed to put money into them today, now, before you pass away. If you don't, some estate plans create trusts, as I mentioned before, within the will. As I gave you that example before, where if I have assets flowing through my will and I have minor children and I want a trust to be established on their behalf, if I have to go through the will to fund a trust, then that means I have to still go through the probate process. So just be clear. I've got a lot of clients that ask that question, and it is confusing based on how assets are titled, how they're owned, and how things are going to be established, like a trust. If you fund it today, it's more likely that it's going to avoid probate because you can name beneficiaries. For real estate, the use of a trust beyond, well, let me back up for a second. If I'm married and I own a home together or any kind of real estate, if I'm married, you can do it tenants by the entirety. If I'm not married, you can do it fee simple. And these are all types of ownership that will automatically transfer ownership to my spouse or the other owner in the event that I pass away. What happens though if I've already lost my spouse, I'm the sole owner of my property and I want my children to receive it? If you look at the deed and it just has my name on it, that means that it's going to go through the will and then hopefully pass to my children, presuming that's why I've listed in my will. That means the house needs to be probated. It's not the worst case scenario because, while probate takes time and energy, nothing happens quickly with real estate. You got to clean it out, clean the house out. You got to get a realtor. You got to get it listed. You got to get a buyer. They got to go through inspections and then sign up for a closing, and then you sold the property. So that takes some time anyways. But if you do want to avoid probate for your residents and you're single, then you need to take a look at a trust, because that's the only way that I'm aware of transferring ownership. There are other I guess I shouldn't say it's the only way, because there are other things like life estates that get more complex. But for most people that are single and they want to pass the asset over to their children, and it happens to be real estate, then you really need to consider a trust. We got another poll here, so let's take a look at poll number 2. We're gonna now start discussing estate taxes. And the question is, what is the federal estate tax rate? And this is a little tricky because when you're looking at some of these, the prior estate tax rate was some of these numbers, but I'm really asking, what is the current federal estate tax rate? All right, so we've got a good amount of the polls in. I'm going to close the poll and share the results. And let's see here. We got people chose 39.6. 60% of people chose 39.6, and the balance chose 34%. So 39.6 is the highest income tax rate. So I was a little clever there. I snuck one in there. That it is not the federal estate tax rate. The federal estate tax rate is actually 40%. It used to be 55%. I think it even came down to 50% at some point. It's been changing so much over the years, but currently it's at 40%. There is talk about eliminating the estate tax altogether, at least at the federal level. I haven't heard much talk at the state level, at least when we're talking about Massachusetts. All right, so let's get over to estate taxes. All right, so estate taxes. In a simplistic example, if I'm married to my spouse and I have $1 billion, when I pass away, I can leave the money to my spouse, and my spouse will not owe any estate taxes when she receives that $1 billion. The challenge is when my spouse passes away. If she's going to leave the money to our children, then we now have non-spouse beneficiaries that apply. And non-spouse beneficiaries is the thing that triggers potential estate taxes. The challenge is, in order to do at least the most popular strategy utilizing trust to help reduce estate taxes, you need to do these types of plans or incorporate these types of plans before one of the spouses passes away. And the reason for that has to do with this next bullet point, that's the federal estate tax exemption. So what this is saying is that at the federal level, that I can pass away with $5.49 million or less, and if I leave it directly to my children, I have an exemption that equals $5.49 million, and so I will not owe any estate taxes. If, however, I left $6.49 million to my children, they are non-spouse beneficiaries, they're not entitled to the 100% marital deduction, I got a $5.49 million exemption. as a result, I would include $1 million after I subtract the exemption, and that $1 million would be subject to a federal estate tax at 40% or up to 40%. And so I would lose a couple $100,000 in that scenario. And so one of the beauties of some of the tools that we have available, especially for married families, married couples, is that if you do some planning ahead of time while both spouses are alive, you can make use of 2 of these exemptions. So in my example earlier, if I were, let's say that I have $10 million and I want to leave the $10 million to my spouse or for her benefit, and then when she passes away, we have 2 kids and we want to have the assets passed to the 2 kids. What we can do is when I pass away, I can put $5.49 million into a trust, because that's a non-spouse beneficiary. That would normally trigger an estate tax. However, there's an exemption of 5.49. So I can put $5.49 million of our total of 10 into a trust, and that trust can even be for my wife's benefit. There are some limitations that are embedded in there in terms of access for my spouse, but if she needs the money, she can usually get access to it, especially the income that it generates. And I can leave the balance of, it's about $4.5 million, I can leave the balance of that directly to my spouse, and she can live off of that $4.5 million. When she passes away, if that asset now grows up to $5.49 million, she is now entitled to an estate tax exemption, so that $5 million or $5.49 million can now pass to the children. Plus, my children can get the trust that I originally set up when I used my exemption. So really, there are ways that you can pass a lot of money and double the exemption amount to your children, thereby saving a bunch of money in estate taxes. There are strategies to lower the estate tax. I just talked about the irrevocable trust. There was a law that was passed. It actually started in 2010, and it really rolled out in 2011 and 12, that it created this concept known as portability. So for those people that did not plan ahead and they did not incorporate irrevocable trusts, it allowed the surviving spouse, in my example, my wife, it allowed her to file an estate tax form and say that she wanted to preserve the exemption amount that I did not use. So in theory, we're also allowed to double the federal exempt amount. Now remember, this is a federal rule, this is not a state rule. Here in Massachusetts, we have a lot of families that we help and support have state of mass estate exposure. But at the federal level, for portability, for those people that didn't incorporate the irrevocable trust, portability is a nice thing to lean on so that we can still preserve the exemption amount, the federal exemption for the decedent. In my example, it would be me. So now my spouse would have a close to $11 million of an exemption, and we didn't even do the irrevocable trust strategy. So it's led a lot of attorneys to question whether and a lot of families to question whether the irrevocable trust strategy, which has been around for 30, 40 years, is still a viable strategy. There are still some benefits that the irrevocable trusts offer, and if you do live in a state like Massachusetts that does have a state estate tax, then the only way that you can really help to reduce estate taxes is through the use of irrevocable trusts. There are some other things that you can utilize to reduce estate tax exposure, as I listed below. They usually involve gifting. So just a reminder, everybody's allowed to gift somebody else $14,000 per person per year without having to file anything. So if I wanted to give my brother and his wife $14,000 each, I can write them each a check for $14,000, and I can reduce the size of my estate by $28,000, and I didn't even have to file a document to do that. If I want to give them more money, then I can do that, but there are things that you need to start filing if you're going to do that. That's really to go over some of those strategies. Maybe someday we'll do a more advanced estate planning strategies seminar, because there are a whole bunch of things and ideas that come into the gifting and ways to reduce your estate so that you have less exposure to estate taxes. Another option is set up college savings 529 plan for either your children or grandchildren. Those assets, it's strange because the grandparents can establish a 529, they can fund it with their own money, they can control it on behalf of their children or grandchildren, but yet that asset is not included in the grandparents' estate. It's kind of a quirky thing, but 529s work very well in this scenario when the goal is already to help pay for somebody's education. And 529s were done right by Congress. There's a lot of perks and reasons to use them if you know that children or grandchildren are going to be going to college. I think my colleague David Giuliano had discussed 529s in the college savings educational campaign that we ran last month. And then irrevocable trusts I already discussed. So I've got one more poll for everybody here. Hopefully everybody's paying attention. What is the state of Mass exempt amount? So how much do you need to have of an estate before you really need to start worrying about owing state of Massachusetts estate taxes? Good. Okay, so I'm going to close this down right now, and we'll share the results. So 80% of you said 1 million, and you're correct. $1 million is the amount. So if your estate is greater than $1 million, then you have state of Mass estate tax exposure. What are some solutions to get around that? They really are the same ones that apply when we're talking about at the federal level. You know, you can make some gifts. You could start 529 plans. You could use irrevocable trust. Another one that I sort of joke around about, but yet there are clients that do it, is move. Go to New Hampshire or go to Florida, because they do not have an estate tax in those states. In fact, most states do not have an estate tax, but we live in a state that does, so we just have to deal with it. Let's see here. We've got attorneys or do-it-yourself. So for those people that do not have, this is really the goal here, is to give you a sense of how do you create an estate plan. I think it's obvious that an estate planning attorney, you could go see them, him or her, and they'll help you create these documents. They'll identify the documents that are most appropriate, and then they'll help incorporate a plan of action for you. I think for those people that have estate tax exposure or a more colorful family dynamic, I think it makes sense to go see an estate planning attorney because there are too many nuances and things that need to be customized and taken into consideration for you to find solutions in a software that would match that. For the do-it-yourselfer, I've listed here Willmaker. I'm not on their payroll. I don't get paid by them. You can download their software at nolo.com. It's offered by Intuit, is the group that also does TurboTax. So they put the engine here, and Nolo is the law firm that helped write all the legal code, and they're the ones that update the language in these documents. They are valid. You just end up putting in what is your state, and you follow the bouncing ball and answer the questions. So for those people that don't have federal or state estate taxes, or they have a simple family situation, like I discussed earlier, sweetheart wills, then Willmaker, I think, is a fine solution. How often should you review your estate plan? I think for people 20, 30, 40, maybe even 50s, you know, every 5 to 10 years is probably a good idea. Or if you hit a life stage where I talked about before, if you got married, you have a child, you lose a spouse, you get divorced, those are all important life stages, and you should ignore the review frequency and just get it done. As you get older, and I would say retirement is probably the time to start doing that. I would say every 3 to 5 years, dust it off, take a look at it. make sure that all of the individuals that are listed are still living and that you still are comfortable with them handling their role in your estate plan. If you're not, then it needs to be updated. All right, some upcoming webinars that are coming real soon, actually. So we've got Chris Gauthier, our CIO corner. He's going to be giving a quarterly update. This is his first time doing this. If it's a success, then we're going to continue to do this. It's our goal to keep people informed about the market and portfolios, and I think it'll be a good opportunity for people to hear more from Chris Gauthier. He has a lot of good information to share. That's going to be Monday, October 30th. Again, you can sign up on all of these at our website. The executive and corporate benefit planning. So if you know any executives that are at any kind of companies, that they usually have some just more sophisticated or challenging pieces of their finances. For example, stock options, restricted stock, employee stock purchase plans. You know, these are just more complex employee or corporate benefits. And David used to actually work at a company for about 10 years where they worked with a lot of executives on certain corporate benefits. So he's going to be presenting this Tuesday, November 28th at 2 o'clock. And then I'm going to be presenting strategic income tax planning at year end. And that's done on purpose. Of course, we're doing it on the 27th, so you're not going to have too much time. So right after I give the presentation, if there's any tidbits that you want to utilize, then you'll have to work very diligently on it, or at least build it into next year's agenda. At this point, we're going to open it up to any questions. My colleague Amanda will jump on the line and read off any that came through.
Hey, Jamie, just a reminder to everybody to use the questions box down at the bottom of your taskbar. Some of you were trying to send in questions and they weren't all coming in all the way. So if you could just double check my responses too. We want to make sure we answer everyone's questions today. Some of the ones that did come through, Jamie, the first one is, are there different ways to own an asset jointly? How is that handled in regards to avoiding probate?
Yep, good question. So this is an area that's surprising for a lot of families. Well, I shouldn't say a lot. When we find the scenario, they're usually surprised. Most people own things joint with rights of survivorship. They usually own it with their spouse. When you see somebody owning an asset that is not owned with a spouse, it is more common that you'll end up seeing tenants in common. Tenants in common does not avoid probate. In fact, the whole idea of that is to have it go through probate. So I think in my example that I gave earlier, if I own, let's say my brother and I open up an investment account, and he put in 50,000 and I put 50,000 in. If I were to pass away, I want my spouse and my family to get my 50,000 that I originally invested. I don't want my brother to just inherit the full 100,000. Then we would own it as tenants in common. But tenants in common means that it needs to go through my will. So if you want to avoid probate, you need to take a look at some other ways of ownership. Joint with rights of survivorship is a way to do that. But again, there are pros and cons, because then my brother would get that asset. So just be aware of what kind of joint ownership you have. Ask the questions, take a look at the documents.
Jamie, the next question we have is, does New Hampshire have a state estate tax?
Yeah, that is a tongue twister there. Yeah. So no, they do not. So New Hampshire, Florida, those are one of the benefits. Not only does New Hampshire and Florida not have an income tax, but they also do not have a state estate tax. And most states do not. But Massachusetts does. And I want to say there's like 20 different states that have an estate tax.
The third question we have is, you mentioned that at retirement you should give consideration to trusts. Why not younger?
Yep. Yeah, I think just by the very nature that, you know, as you're getting closer to retirement, that's usually when you have more in assets than at a younger age. You know, there are some exceptions. You know, I mean, I'm 42. I think I'm 42. I'm 42 and I use trusts. You know, I'm a nerd with all this stuff, so I like all this stuff, and obviously I deal with trusts all the time, so I'm very comfortable with them. But those, for younger adults that want to avoid probate, yeah, that's a valid reason. Although there are a lot of other ways to avoid probate. Trusts are not the only way. For younger adults that have a lot of life insurance, then yeah, I mean, I could see that, because life insurance is part of somebody's estate. So if you know, if you're 40 years old and you saved up $500,000 and you also have a $2 million life insurance policy, then your estate is $2.5 million. And you would be subject to estate taxes in Massachusetts. So trust work could help. I just find that most often we have people that have more money at retirement, and that's the point where we're looking for those individuals that have greater than $1 million net worth, and then we start the conversation about the importance of trust to at least give consideration to that to help reduce estate taxes.
Okay, Jamie, this one's a little bit of a scenario. What would happen if I had designated 97% of my 1.1 million brokerage account to my spouse and the 3% to my adult child? What would be the mass estate tax implication there?
So again, 1.1 million, and you're saying that if you pass 97 over to the spouse?
Yep, and 3% to the adult child.
Yeah, so the whole idea is just to get the estate below $1 million. Well, it's not a big deal. Remember, spouses are entitled the marital deduction. So no matter what, Massachusetts estate taxes are not going to apply when I leave money to my spouse. So even if you left 100% of that $1.1 million to the spouse, there's still no estate taxes owed upon the first one passing. It's when the second spouse passes away, which then you can't leave it to a spouse, right? And so you're going to leave it to your kids, and then you would be subject to estate taxes because the full 1.1 million would be included. You're above the $1 million exemption, and at least in Massachusetts, I know people aren't going to like to hear this, but once you're a dollar over $1 million, they actually apply the tax to including on $1. So all the $1 million threshold is just to see if you need to file an estate tax return in Massachusetts. If you do, then you're going to end up owing estate taxes on the full $1,001,001.
Okay, it looks like we just have one more question here. It says, how does life insurance affect estate taxes?
Yep, so that's a good one. So if we have a family that has an estate tax exposure anyways, let's say that we've got a family with $10 million and they've got state of Mass estate issues, estate tax exposure, because again, we can avoid at $10 million, we can avoid the federal estate taxes, but we can't avoid state of Mass. So if I can't get them to move to New Hampshire or Florida, then we would need to incorporate some estate planning documents that include trusts. We would not be able to shelter $10 million. At most, we could probably shelter $1 million up to $2 million, because again, each spouse is entitled in Massachusetts to a $1 million exemption. So in theory, we could shelter $2 million out of the 10. That leaves $8 million subject to estate taxes, and it's the tax is not going to be pretty. So you can start giving away assets to help. You can prepay taxes by converting IRAs over to Roths. I mean, there's a whole bunch of different strategies that you can utilize to spend down the $8 million that's got exposure to estate taxes, but inevitably you're probably not going to be able to get rid of it all, so you're going to have some estate tax exposure. So in those scenarios, we'll actually suggest, well, you got to pay a tax, or your kids will have to write a check to the state of Mass. How do you want to do that? Sometimes they'll just do it out of the $8 million. Sometimes we end up purchasing life insurance. If you purchase life insurance, you have the choice of owning the life insurance in the estate or out of the estate. And so we can actually purchase life insurance out of the estate in certain circumstances. They call these ILITs, irrevocable life insurance trusts. So you use a trust to purchase the life insurance that will be used to pay the estate tax. so that you don't have to use any of the $8 million. Now, granted, you have premiums that need to be paid if you want to incorporate life insurance. So that will create an expense that you'll need to use the $8 million for. But, you know, it is a solution. So if you're not including these trusts to own the life insurance, then yes, life insurance is part of the estate, and that needs to be taken into consideration. When I ask people what their net worth is, especially when we're trying to determine death taxes, inevitably most people are not including life insurance in that math. You need to include the life insurance, and you find that you might have more exposure than you thought you did.
Jamie, we have another question. What if I pass $900,000 to my child and the rest of the estate to my spouse? Does the child have to pay mass estate tax?
No, you're under $1 million, so you're fine. So you'd be entitled to the exemption, and the kids. I mean, I think I even said it earlier. The kids don't pay it; the estate pays it. But no, if the money that's going to the spouse, those are entitled to 100% marital deduction, so I don't need to worry about that. And so the taxable estate would be $900,000 because it's going to a non-spouse, but Massachusetts gives you a $1 million exemption, so you can pass that $900,000 without any estate tax exposure.
What if you have a revocable trust? Do you avoid estate taxes?
Well, yeah, I mean, I think you said revocable, right?
Yes. Yes.
Okay, so yeah, revocable trusts just mean that, you know, you can change the terms. Most revocable trusts don't do anything for estate taxes. If you have certain revocable trusts, I call them estate tax sensitive trusts. It starts with a revocable trust that I own or my wife owns. But then when I pass away, I designate a certain amount of money that goes into an irrevocable trust immediately upon my death. And that's what becomes a non-spouse beneficiary. I got to use up my exemption at the federal and state level, and the balance of money can go over to my spouse. So it's more the use of irrevocable trusts in the plan that helps to reduce estate taxes. But keep in mind, they become, usually it's revocable that becomes irrevocable when somebody passes away. Most people don't have revocable trusts that are estate tax sensitive. The attorneys structured these trusts instead to help you avoid probate. The way that you tell is when you read through the documents, it says, upon my death, this is what I want to have happen to the assets. If you see any reference to the federal estate tax exemption or the state of Mass estate tax exemption, then you're in pretty good shape. Obviously, you can call your attorney to confirm, but more than likely you have chosen to have the estate tax sensitive trusts created. So again, you can have revocable trusts, but there's two different types. And you got to have the estate tax sensitive trusts that reference federal and state exemptions in the plan or in the trust, and those will help reduce estate taxes. Most people do not have that, and so their revocable trust will not help with estate taxes.
Continuing on with questions about trust, can you do it yourself, the trust, or should you get an attorney?
Yeah. Well, I mean, if you're doing the trust for, let me see if they even say it here. They don't. Protect your family. I believe these do trusts. It's more of the one that I was just referencing to avoid probate. I've never heard of estate planning software that incorporates the estate tax sensitive trusts in there. I guess it's possible in theory, but there are a bunch of different types of trusts that are estate tax sensitive. There's disclaimer trust, there's credit shelter trust, there's bypass trusts. And the whole idea is to not have the assets flow to your spouse, but to sit in an irrevocable trust that is accessible to your spouse if they need it. That's the whole idea and goal. And I haven't seen any of the softwares create those kind of trusts. They just do the types of trusts that say, here is, you call the trust whatever you want, tell us who the trustees are, tell us who the beneficiaries are, tell us who you want to step in line as the new trustee if you become incapacitated, and go ahead and put assets now into that trust. That is just structured to avoid probate, which is a valid reason to have trust. It's not the only way to avoid probate, though.
Jamie, thanks so much. I think that's all the questions we have for today.
Excellent. I'm always around, so if anybody has any questions, you should have access to my email, call the office, just let us know what's on your mind. Thanks again, everybody, for joining us. Take care.